Good morning, it's Frugal here. As always, I have my coffee because otherwise somebody might just get killed. So today, let's talk about investments, right? So you want to start investing, and as part of the six important ways of personal finance health, it's important that you invest for the long run. So to start off with, we know that investment and savings are not the same thing. Savings tend to be for a smaller goal where, like short term, maybe a holiday, maybe a computer, maybe something small like that. On the other hand, what we have investments. Now, investment is for wealth accumulation, which is long-term financial well-being. So it might be a 10, 20-year plan that you have for investing. And because you've got a longer spectrum, you might want to invest in something a little bit more risky. But we're going to talk about that in a moment. So savings is important. You need savings, right? You need to have that little goals, that little things that's going to be great. It might be saving for a deposit, for a house, saving for a car, saving for something small right now. And then what you have is you might have that long-term goal, which you can invest the money for, which might be in 15 years' time. You want to buy a property, cash, if you are inclined to think, you want to do that. It's cool. Less interest to the bank. Well done if you can. But okay, so investment, right? Now we're talking about investing in wealth accumulation. Now there's three factors that you need to remember when it comes to wealth accumulation. The first thing is the rate of return. That is the percentage of interest that you would get, or the amount that your money would increase if you invest your money. Remember, you invest your money so that you can make money, right? So that's the first one. The second thing is the time spectrum that you have. So if you only have a month, don't put it in a high-risk investment that can go up and down daily or even monthly. Or even yearly. If you have a short period, you want it a little bit safer. If you have a longer period of time, then you can be a bit dodge in that. So, and the third thing, obviously, then, so we said that it's rate of return, we've talked about time, and then third one is the amount of money that you can put in. So a lot of people try and manipulate the rate of return. They try and say, I'm going to adjust things a little bit, and I'm going to try a Ponzi scheme and it's going to give me big cash in a little amount of time. But eventually it does come down to how much money can you actually put into it. It's similar to a business, it's similar to anything in life. The more you put in, the more you get out. So that's really the short and the long of it. So I'm going to talk about platforms in a bit, but before I do, I want to talk a little bit about what you can invest in. So there's a couple of things you can. The first thing is stocks. So stocks is you buy a share in a company. This might be a listed or not listed company. What that means is that it might be listed on the stock market, such as all the stocks you would get on the Johannesburg Stock Exchange or the New York Stock Exchange, and then you invest in that company, and if the company makes profit, they will pay you dividends. And as the company grows, the stock price can grow. Now, obviously, there's different types of things in there which we don't always see. Things like, for example, the brand Coca-Cola, like the trademark and the logo is worth quite a lot more than what the actual stock is worth. So there's a lot of technicalities on that. It is extremely high risk, right? If you don't know what you're doing, because you're literally throwing just money around and you just make more money. And stocks goes up and down. If there's a hurricane, if there's something like oil leak or something in the Mexican Gulf, or if there's a war or something, stocks prices goes up and down. So it's not for the faint-hearted, okay? It's not something that you can say, no, I'm just quickly going to invest in that and I'm going to withdraw the money in a month's time. You do get certain things. I'm going to get into funds and those in the moment as well. But you get bonds, which is the next one. So stocks, now bonds. Bonds, basically, a company says, listen, I need money to cover some of my expenses. So you borrow them the money and you go, here's my money, and they give you what they call a coupon. A coupon is very similar to interest, what you would get at your bank. So you basically get a little bit of interest, which might be 1, 2, 3, 10%, depending on how good the deal is. Now, for the general public, what we can do is we can invest in retail savings bonds, or RSAs, the RSA bonds, which are basically borrowing the government money, and they'll repay it over a term. Now, obviously, if a company fails, then you might not get all your money back. But having said that, loans tend to be favored above stocks. So what the people that have the bonds will actually get the money first, or the first percentage, and that what's left will be split amongst the shareholders, which is the people that bought the shares. So where can you buy these things? Well, you can buy them on Easy Equities, you can buy them on the FranCap, you can buy them through a broker, a financial advisor, you can buy them directly from very big companies. Your banks actually allow you to do that right now. So there are many places you can decide to invest that money. And it's 100%, you can do it. It's cool. You're more than welcome to choose the platform that you like. Go and check out their fees. I find that personally, places like Easy Equities fees are very low. If you have no idea what you're doing, then I think the FranCap is a very good place to start. But also some of the banks, I know that they're doing some really, really cool products recently, but it's not that well known at the moment. So stocks, bonds, cash and equivalents is the next one. Now, cash or equivalents, basically what that means is I'm investing in something that is cash related. It is, say, a savings account at your bank. You put the money in, they give you interest, which just covers inflation. And that is extremely non-risky, right? Because you know you're going to get your inflation related returns. It's not a lot of money, but it's something, right? It is at least something that you can get in your pocket. So, like with regards to that, to people that's very close to retirement and don't have a long time horizon tends to invest more into cash and bonds because of the low risk that they have compared to something like stocks that can go up and down like crazy in a single day. Now, cash and equivalents is very, it could be anything. It could be something like gold as well, because you can convert gold very quickly into cash. So don't think that it's just a money market account, okay? It can be something more than that. On the other hand, the fourth one that you get is you get property. Now, property could be quite a couple of things. There's something called REITs, Real Estate Investment Trusts, and these are also on the stock market. And it's a lot of people that basically give money to this thing, to this trust, and they basically take off their costs and everything, and you get some of the profit of the rental property in their property business. There's also property stocks. So, for example, some of the companies, what they do is they build property or they rent out property, and it's their business, right? It's a PTY Limited, it's a company. You can also have your own rental property. I think that, look, that's what I invest in and that's what I love. I know what I'm doing there, but if you don't know what you're doing, please do your research, as with all of the above. So rental property can be lucrative. There's lots of tax breaks that you can use. Make sure about the area that you do. Make sure you're buying a good deal. I've got lots of other videos that you can check that out if you are interested in property investing. And yes, there are other places as well, such as Easy Properties, that you can invest, or even property stockfels, which are really, really cool, and you can actually do that as well. So, and then the last one, which are not like talked about. So we've talked about stocks, we've talked about bonds, we've talked about cash or equivalents, we've talked about property. Now we need to talk about alternative vehicles or alternative asset classes, right, where you can invest your money. That would be things like cryptocurrencies or something like NFTs, or even wine and paintings and things like that. It's not necessarily everyday things that people would buy, but it is up and coming. It might be a little bit more risky, but people that know what they're doing can make quite a lot of money from that. So it's really cool if you do know a little bit about something like that. Also, something like business, it's alternative. It's not the standard thing. You might have a business that you can sell or that you can actually get an income from without working. But in the long run, those things can give you capital gains or cash flow, recurring income. So after discussing those, I think let's quickly just check about what that difference is what I just mentioned. We talked about cash flow, i.e. recurring income, and we're talking about capital gain. So capital gain is something that gives you money right now. So basically, I buy a painting, I sell it within 10 years, I make a lot of money, and the profit that I make is capital gain. I get a capital injection, a money injection into my life. On the other hand, what I have is I have recurring income or passive income. And what that does is that gives me a monthly cash flow, something like rental property, or something, like dividends to a certain extent as well, which would basically give you a cash injection every year or every 6 months, depending on what stocks you buy or what ETFs or funds you buy. So it is cool to have that bit of money extra, for selling that painting, or buying gold and selling it, or buying that property and selling it, and getting that little bit of cash. Obviously, you need to check the tax on that, right? But we'll get to that in a follow-up video. So concerning that, what you need to remember then is you need something that's going to give you monthly income, but you're also going to have to give something that grows your money. Okay, perfect. So we've covered quite a lot there. Anything else that we need to cover? Yes, we need to cover funds, ETFs, and tax-free savings accounts. So the government did some really cool things, and they created what they called wrappers. So a wrapper wraps a package, right, of stuff that's inside. So you can put money into it. And if it's inside of that, it actually has to basically adhere to the rules of this package, of this wrapper. Now, two of the most well-known wrappers are, the first is a tax-free savings account. The second one is a retirement annuity. So a tax-free savings account has got a couple of rules because it is governed by this wrapper, this thing. And what it does then is it says, okay, I'm going to, you're only allowed to invest 36,000 Rand a year as of 2021. And you basically can only do 500,000 Rand in your lifetime that you can put into this wrapper. If you take the money out, you can never put it back. If you've reached your limit of 500,000 Rand, you've reached your limit of 500,000 Rand that you can put in for your lifetime. If you've taken out 5,000 Rand, but you've already put it in, so it counts as per your limit. What's cool about it is that any profit that you make on that is tax-free. So for the long run, if you want to invest for retirement, or just invest for 20, 30 years, or even if you are a bit older, it is really cool because you can have multiple things in there. It is to help you with a culture for saving. So you need to remember that if you do this, you're not going to be able to buy shares. You're not going to be able to buy commodities such as gold or oil, because what they want is they want you to invest for the long run and not speculate on it. So what you'll do is you'll say, okay, I'm going to invest in things like funds, ETFs, cash or equivalents such as money market funds, or things that gives you a little bit of interest. Now, like I said, all money on that is tax-free. So you might say, well, at this point in time, it doesn't matter. Yes, but what happens in 20 years' time? What happens when you actually do need to, when you're going over the limit of the tax bracket? Well, that's why the tax-free savings account is so amazing, and you need to start on it today. So I quite like tax-free savings account. If you want to, you can. If you don't want to, please don't take my financial advice. Go and speak to your financial advisor and do your own research, right? Now, I've used a couple of very big words such as ETFs and funds. And I think it's worth explaining this because it's so valuable. So concerning a fund, what a fund is basically we've realized that sometimes you can't buy big stocks, right? So for example, an Apple stock might cost you $5,000. That is a lot of money for an Apple stock to buy, to take like 100,000 Rand, 75,000 Rand or something and just put on one stock. That is really a lot of money. So what they did is they went and they said, okay, I'm going to go and I'm going to create a fund of lots of people that's going to put their money together, right? And everybody puts their money together into the little kitty, and then from there on, they're going to buy different things. So you get active managed funds and passive managed funds. An active managed fund is a guy sitting behind a computer and saying, yes, this is going to be really good. I'm going to invest in that. And then they day trade, right? They change it. They're going to buy that. They're going to sell that. And they're going to, stocks and bonds and things, they're just going to trade the things around until they're very happy. Now, on the other hand, what you get is you get things like passive funds. Now, passive funds tend to be things where there's a set of rules, or they say these are the things we're investing in, we're not trading, and they might relook at the thing at a very, very low interval, not on a daily interval. So when it comes to passive funds, they tend to outperform active funds, specifically because trading costs money. So, but further now, let's talk about ETFs, because that is exceptionally important, and it's very good that you know about that. So when it comes to funds, generally they talk about unit trusts or units that they sell, and those things can be, they decide that, very intelligent people decide that these are the things that they're going to invest in. But you also get something called an ETF. Now, ETF is also a fund, right? And it's also traded on an exchange traded fund. Now, what happens with an ETF is that there's a rule set that some very clever people think out, like the JSE Top 40. They're saying the top 40 stocks by market cap. That is the biggest stocks, basically, according to how much money they're worth, the company's worth. And if you are in the top 40, you will be in an ETF, or you will be in that fund. And if you're not, we're going to chuck you out. So what they'll do is they'll say, okay, for example, if the fund now but the stock is not in the top 40 anymore, it's moved down, something's moved up, it'll literally what they call rebalance or re-index. It'll move the one in and sell the other one. So at least you know that it's the top 40 always. Now this is really cool because it's a scientific formula, which means there's not people that has to get salaries and get paid. It's all automated, and you know that you'll always have the top 40 stocks. There's quite a couple of indexes which are really cool, things like the MSCI World for developed countries, the S&P 500, the Ashburton 1200, the JSE Top 40, there's the Dow Jones Industrial, there's loads and loads and loads, like an all-share index. There's loads of these indexes, and what basically happens is the fund tracks the rule set or the index. So it says, okay, if the index changes, the rules, it gets applied to something, we're going to change and sell and buy as we want to, which makes it quite cool because you don't have to worry about, okay, do I own a stock which is absolutely worthless, or that the company is corrupt? Because the rule set might say, okay, if you're not in the top 40 anymore, we're not in there anymore. Or if you're not in the tech space, then we're not going to buy you. So you don't have to worry about technical things like that, which makes it quite nice. It's really, really nifty. And it makes it less hassle for you and for fund managers. So just to mention, you need to remember that there are fees that you're going to have to pay. So whether it's in property, you're buying, paying levies or rates and taxes, or whether it's in stocks, you're paying a management fee, or you're paying a buying and selling fee. There's always fees that you're going to have to pay. You're not going to get around that. But what you can do is you can try and minimize the fees as much as you can to optimize your returns. Okay, so in this video, we covered the basics of what you can invest in. We touched on some of the platforms that you can invest in. We've also touched on what funds are, ETFs are. We touched on fees. I just want to mention here, while I remember, a financial advisor, if you want to use one, that's 100% fine. They're going to charge you anything between 1% and 3%. I believe that 1%, in the region of 1%, is acceptable. Between 3% and 10% is unacceptable. And 16.5%, which I have seen, is totally bonkers. And those people need to go to jail. But that's just my personal opinion. Please don't quote me on this. So, and we then looked at, like I said, tax-free savings accounts and wrappers and rule sets around that, indexes. And with all of these things, you can decide now and speak to your financial advisor if you have to, or start looking at things what you can invest in. Now that you know a little bit more about investing for wealth acquisition, have a wonderful day and happy investing.